shoeshine boy gave Joseph Kennedy a stock tip in 1929, and within hours, Kennedy sold everything. That same pattern has appeared before every major crash, including the one experts are worried about right now. October 24th, 1929. A shoeshine boy on Wall Street corners Joseph Kennedy after buffing his shoes to a mirror shine. "Mister, you should buy some Radio Corporation stock. My buddy says it's going to triple by Christmas." Kennedy hands the boy a nickel tip, walks 3 blocks to his office, and immediately calls his broker. But he's not buying, he's selling everything. Within hours, Kennedy has liquidated his entire portfolio. 5 days later, Black Tuesday arrives, and the American stock market experiences its most dramatic downturn in history. Yet Kennedy's wealth remains intact. He understood something that millions of investors missed. The most concerning words in finance are not, "the market is crashing." They are, "this time is different." This is empire economics, where money and history collide. And today, we're uncovering the 4 trades that the most sophisticated investors consistently make before major market downturns. Not theories, not speculation, but the actual patterns repeated across nearly a century of financial crises, from 1929 to 1987 to 2008, and the warning signs flashing today in 2025. The story begins with a paradox. Every major market decline in history was preceded by the same phrase: the market always goes up. In 1929, it was Charles Mitchell, president of National City Bank, declaring that stock prices had reached a permanently high plateau. In 1999, analysts claimed the internet had changed everything and old valuation rules no longer applied. In 2007, it was widely believed that subprime mortgages posed no significant risk to the broader economy. The words change. The delusion remains identical. But while the masses chase the euphoria, a small group of investors quietly execute the same 4 moves. They don't predict downturns, they position for them. And when volatility arrives, they often emerge not just intact, but significantly stronger. These aren't lucky guesses. They're systematic responses to recurring conditions. Because downturns rarely appear out of nowhere, they're the final chapter in a story that has been building for months, sometimes years. The first trade is the most counterintuitive. While everyone else is buying, these investors start selling. Not everything, not all at once, but methodically, quietly, without drawing attention. Jesse Livermore began shorting stocks in early 1929, 6 months before the crash. He used over 100 different brokers to conceal his positions. By spring, he was down $6 million on paper. Newspapers mocked him. Fellow traders called him finished. But when October arrived, Livermore walked away with over $100 million, nearly $2 billion in today's money. The psychology behind this move is demanding. Selling into strength requires ignoring the crowd, the media, and often your own emotions. It means accepting temporary losses for long-term protection. Paul Tudor Jones demonstrated this perfectly before Black Monday in 1987. While automated strategies convinced institutions they had eliminated risk, Jones studied historical patterns. He noticed that the structure of the 1987 market closely resembled 1929. Automated systems were creating feedback loops similar to the margin call spirals decades earlier. 2 days before the decline, Jones warned that investors should reduce exposure. When the Dow fell 22% in a single day, Jones's fund performed exceptionally well. The second trade challenges conventional ideas of safety. When markets reach extremes, sophisticated investors often rotate out of traditional safe havens and into assets others view as unconventional. In 1929, while ordinary investors fled to cash and government bonds, experienced capital moved into gold, real estate, and foreign currencies. During the 2008 financial crisis, Warren Buffett made his most notable investments at the height of uncertainty. In October 2008, While global markets were under stress, Buffett wrote, "Be fearful when others are greedy, and be greedy when others are fearful." But he wasn't simply offering advice, he was taking action. Buffett invested $5 billion in Goldman Sachs preferred shares, earning a 10% annual return plus warrants. He made a similar deal with General Electric. These were not risky bets, they were carefully structured agreements. Goldman later bought back Buffett's shares at a premium. His return exceeded 40% in just 3 years. While many investors struggled through the downturn, Buffett strengthened his position by betting on eventual recovery. The third trade requires something even deeper: understanding market structure itself. These investors don't just analyze companies. They study how markets function, where pressure points form, and how those points behave under stress. This becomes critical during periods of high leverage and speculation. In 1987, portfolio insurance strategies were designed to automatically sell futures contracts as markets declined. The idea seemed sound. The execution created a chain reaction. Falling prices triggered automated selling, which triggered more selling, which led to further declines. James Simons understood this dynamic better than nearly anyone. His fund, Renaissance Technologies, used algorithms to exploit market inefficiencies. When human traders panicked during the downturn, Simons' systems executed calmly. Renaissance generated positive returns that year while the market fell sharply. The fourth trade is the most sophisticated of all. These investors create optionality, positioning themselves to benefit regardless of direction. This isn't about predicting the future, it's about preparing for multiple futures. Michael Burry exemplified this before 2008. While the public focused on rising home prices, Burry examined mortgage securities. He found that many subprime loans were structurally weak. His solution was to purchase credit default swaps, insurance that paid out if underlying mortgages failed. When the mortgage market collapsed, Burry's fund returned over 480%, while the broader market declined. But the brilliance wasn't the prediction. It was the structure. His maximum loss was limited to the premiums he paid. His potential gain was much larger. This asymmetric approach, limited downside, expanded upside, is a defining feature of investor behavior at the highest levels. Today, in 2025, we're witnessing similar patterns. Jamie Dimon, CEO of JP Morgan Chase, has publicly noted the possibility of significant market adjustments due to geopolitical tensions and extended valuations. Paul Tudor Jones has compared the current environment to previous speculative periods, including the dot-com bubble. And Michael Burry has allocated a large portion of his portfolio to put options against major indices, using the same risk structure that proved effective in the past. But here's what separates these investors from the general public. They're not anticipating disaster. They're simply preparing for scenarios that markets periodically produce. The mathematics of financial cycles have existed for centuries. When ancient empires debased their currency, those who diversified early preserved their wealth. When paper money lost value during the French Revolution, those who adapted quickly made it through periods of instability. The tools change, the principles do not. The fourth trade, optionality, is not about timing, it's about architecture. While many investors focus on stock prices and short-term predictions, sophisticated investors study the foundation: liquidity, leverage, behavior under stress, and confidence cycles. Warren Buffett's 2008 deals were not gambles on recovery. They were structured agreements that offered strong returns under multiple possible outcomes. He built payoff asymmetry into the very design of the deal. Jesse Livermore didn't just short the market in 1929. He positioned himself to benefit from volatility itself. Paul Tudor Jones didn't simply foresee Black Monday. He prepared to capture opportunity when volatility surged. James Simons didn't rely on predictions. He relied on systems that exploited the behavior of markets under pressure. These patterns aren't prophecies. They are behaviors that reappear throughout financial history. Too much leverage, too much speculation, too much confidence in permanence. When these align, instability becomes more likely. Today, we're seeing rising margin debt, speculative trading in options, and intense enthusiasm around emerging technologies. Echoes that resemble past cycles. Michael Burry's positioning reflects how some investors interpret these signals. By using structured downside protection rather than simple directional bets. The 4 trades we've explored today are not predictions. They are reminders. Knowledge doesn't guarantee success, but ignoring historical patterns often leads to unnecessary risk. History doesn't repeat, but it does rhyme. In every bubble, every correction, every moment when optimism outpaces fundamentals. If this opened your eyes to how money and history connect, subscribe for more. The past helps us understand the present, and the future belongs to those who learn from both. This content is for educational purposes only and is not financial, legal, or investment advice.